Anna, we need to have a conversation about something I have been afraid of. I've actually called it my worst case scenario for housing. I think it is transpiring. Obviously, housing is connected to the economy. It's connected to the Fed, it's connected to rates. There's so much going on right now, but I do think we might be living my worst case scenario for housing. How's that for an introduction?
A little more negative than normal, Michael.
Yeah, it's
You know
just
what? It's challenging. What I think there's definitely challenges ahead. When you say worst case scenario for you, what do
Mhm.
you mean by that?
So if people go back and they really parse what I've been talking about for the last 3 months, my fear was is rates would come down, they'd get in the sixes, we'd unlock the marginal demand, we would not unlock marginal supply, and we would start to see bad behavior in the real estate market. What is bad behavior? Waiving inspections, over offers, releasing EMDs. And I had conversations with Beth in Seattle yesterday, Brian Lebo in Vegas yesterday, caught up with an agent in Chicago last night, and all of them are telling me that the numbers that will be reported for February are going to blow you away. Their pendings are crazy. The multiple offers are ludicrous. So
Yeah.
why do I call this the worst case scenario? I think 6.5, 6 to 6.5 is like the worst interest rate possible because it unlocks the marginal demand. Buyers feel like they're getting a deal. There's no supply coming. And you know, Beth told me this hurt when I heard this. She is seeing behavior reminiscent of Q1 and Q2 of 2021, which was the most bananas real estate market I've seen in 30 years.
What
Now,
market is she
Brian,
in, Michael?
she's in Seattle. So the median's a
Okay.
million bucks, right?
Yeah.
And then Vegas, Brian Lebo, I think it's 450 was the median, I want to say.
Hmm. Hmm.
It's, he January numbers, he showed me January. Prices down 7 grand or 2%. Transactions up like 11%. These are year on year numbers. I'm sorry. Price was month on month. Transaction was year on year. Then he
Okay.
told me, "You're not going to believe what February will be." It's like the gun at the Olympics went off and everybody's writing offers. He's writing, multiple offers, and it's just like, and it's at all price points. The
Hmm.
reason we looked because he's great. He does these numbers every month for like 20 years. He's like, the reason the price fell down in January is all the transactions were below the median. So it's just how the median's
Right.
calculated. But he's
Right.
like, Michael, we went from having an absorption rate above $1 million from like 20%, which is 1 in 5 listings are pending. He's like, we're over 40% in like 3 weeks. I'm like, oh, that's just going to rip the median price higher. So at the end of
Yeah.
the day, I call it the worst case scenario because I don't want to see bad. I do not want a repeat of 21. I really don't.
Right.
That's what I mean by worst case.
Right. Right. So I think this is going to be one of those episodes where I disagree with you a little bit. And
I
I
hope you
like it
do.
when
I
we
don't,
disagree because
me
we
too.
challenge each other's mindset, right? Because there is so much, there's so many things that are different, I think, this time than where we were in 2021. But we are, this word has been worn out since 2020, but it's true. We are in unprecedented times. There's a lot of things different about today than any previous real estate market or economy that we've seen. There's a lot of things that with history rhyme today. And I think when it comes to real estate, and generally the economy, we're a lot like the 70s, right? We've been talking about that for 2 years, a lot like some previous periods. But I think that the late 70s kind of shows us a picture of what we could expect into the early 80s. And so I think what's interesting is, one, big cities behave differently than small cities.
Ooh,
That's something that
okay,
I've seen. Okay, so you
okay.
mentioned Chicago, you mentioned Seattle. I'm in smaller markets and I'm invested in some smaller markets, and I'm actually still seeing softening. And so,
Oh, good.
I
Okay. All
think
right.
that when we talk real estate at a high level, I think there's some things I agree with you, and what they're saying and what you're saying, but I think I'm always clued back into real estate is very regional, if not
Absolutely.
local. And so you can see a lot of, global or national trends that are not necessarily going to be what you're going to see in your market. But I think we still have to kind of look at, where do we think the economy is going to be in the next year or two? Because
Okay.
also we see these blips, we see seasonality. Spring is always kind of the seller season. And
Right.
yes, it's kind of still winter technically, but it's warming up in a lot of places. And people did see rates come down a little bit, and they're hopeful now that the Fed's going to cut rates. And so I think they're getting a little excited. So I do think that in some markets, like you said, there's an uptick. My question is that just seasonal? My other question, though, and you pointed to this a little bit in what you said about the high-end homes, is when I look at the economy in general and the strength of the consumer, right? I listen, just for you and for your listeners, I like to tune in to news sources that have like a disparate view of things. So
Yes.
I can see, if I look at Fox or I look at CNBC or I look at MSNBC, it's like you're living in three different worlds because the same
It is.
story is spun in three different ways, right? And so
Yes,
you kind of have
absolutely.
to say there's some truth in there somewhere. But how you interpret data says a lot about your views of where the economy is heading. And on the doomy part from my standpoint, again, I'm very much an optimist, but I'm very data driven. I really like to believe that. But it's hard to interpret data when the data sources are, one, manipulated, and two, have a big lag effect, and three, we don't see the underlying detail of a lot of the numbers that we look at. So when I think about real estate, I say, well, where's the economy going really? And based upon my view of where the economy is going, I think that this exuberance from investors wanting to get back in to buy homes, I think it's going to be short-lived, Michael. And I think it's in that higher end. So
Okay.
a few points that I'll kind of, just point that pop up at the top of my head. One is 88%. This is as of last week, 88% of family households are living check to check. 88% now. It was 76 to 78% a year ago in these surveys. Okay. So
Yeah.
more people are living check to check, number one. That's going to make people nervous about buying a house if they have to trade up their house payment. And the reality is, for most people that are in houses today already, if they own, if they're going to buy a house today, their house payment's going to go up unless they really downsize, right? That's going into these lower end homes, lower, below median or medium. What we're seeing is that the households that are really pushing up are those that have the higher income numbers that can afford the higher house payment. So I think, just like when you look at the stock market, right? You've got this magnificent seven that have just gone gangbusters. I mean, over 107% returns. And I missed out on some of that, sadly, because I thought we would be in recession faster than we are. And so I don't want to be at the end of the tail of exuberance in the marketplace. But when you look at the stock market as a whole, Michael, you see that right now we have crossed something that hasn't happened, I think, in 50 years. It's really dangerous for the market, and it's a good indicator of where the economy is. More stocks are negative than there are positive in the S&P. And so
Yeah.
you might have a few that are doing great, right? But the majority are struggling, more than half. And I think that when you look at households and the economy, the top tier, there are larger and larger wealth gaps post-COVID. There have been, it's
Right.
been an issue for a long time. But those of us that have more money have been a little more astute in knowing what to do, as challenging as that's been to figure out for all of us, to make more money when a lot of people are just struggling. They don't know how to do it. And so the wealth gaps have expanded. And just like not even 75%, most 75% or so of households don't invest in the stock market at all. Some of them do only through the 401k. So even those that are making that killing in the market in the last year, it's usually the wealthier, not the average citizen, of which 88% are living check to check. So I think that the economy and the average American consumer is in much weaker shape than what most people will say. and that the top end is carrying the market. Where do the top end typically live, Michael? In your bigger cities, right?
True.
In the
Yeah.
Seattles, in the Las Vegas, in some of these bigger markets. And so I think that those people generally in urban America that are living in the cities generally are in that higher end. They still have cash on the sidelines. Their investments, if they have been investing, have done really well over the last year, surprisingly. They've got some cash and they're like, okay, we want to move. Let's go ahead and do it now. Rates are going to come down, sometime this year, and we will refinance then. But I think if you look at the general consumer and across most of America in suburbia, and yes, some wealthy families live in suburban markets around big cities. So it's still, I'm calling it a big city market segment,
Understood.
an MSA. But in real rural America, most people are struggling, and I don't think they're going to buy houses. I think this is a short blip. And
Okay.
I think when the economy weakens further and we get into recessionary territory, and I'm going to make a bold call and we'll see if I'm right. I
I like
think
it.
we're in recession now, Michael. It's just not been declared. And I think that the NBER is going to come back and they're going to backdate the recession and say we've been in a recession at least since the end of last year and currently. And when that happens, the average consumer who only gets their news about where the economy is from
Right.
their own, from major networks, and they start seeing all these job layoffs that are really escalating, and they start losing jobs or cutting
Yep.
back on raises, which is happening. I think they're going to be too spooked and they're going to say, this is not a good time to buy a house. It's not a good time to move. Let's stay where we are for a while. And I think transactions come back down, even if we get a temporary blip in the higher end homes, especially this spring.
Yeah, so I like all of that. I think one thing I'm going to do, I'm going to ask the audience, right? You all have your buy box or your areas you're shopping in. Let Anna know what you're seeing there. She's absolutely right. I may be biased to the top 10 markets. And if you're focused on that, then you could be misreading, everywhere else. So let us know what you're seeing there. If you're in a smaller
Yeah.
market, what's going on below and above the median, that would be wonderful.
And
Second.
one thing, Michael, just on that point, I have had two properties on the market, okay, for the
Okay.
last several months that
Okay.
I'm like, they're short-term rentals. I have 5 short-term rentals and I love them all. And we've talked about this a little bit, not to get too off topic, but the short-term rental market is struggling and softening a little bit too compared to what it was before. And so, there are markets where, because of the average American living check to check, 88% of households, they're not spending as much money on travel. And it's been
True.
winter, things are a little bit slower, but I've had 2 properties on the market and the offers that I've gotten have been lowball offers from investors. They've all been subject to, and they don't want to put hardly any money down. And I'm like,
Oh, wow.
I may sell something with some creative financing, which I've advertised I'll do, but it's
Right.
got to be full price and I got a good amount of money down. Otherwise it's no, there's no,
Yeah.
but for properties, I've sold and bought a lot of properties over the years. It's the slowest number of offers I've ever received. And these are good quality assets, but they
Interesting.
still, at today's prices and rates, they barely cash flow for an investor. So the investors are saying, And the thing that I think a lot of people don't give enough credence to is just how many homes were bought over the last few years that were short-term rentals and aren't really residential,
Oh, for
especially
sure.
in
Yes.
some of these markets where people, come for different vacations and things. And so you have more and more supply of those homes on the market, and they're just still not cash flowing. And so they're not moving, even if offers are being made,
Yeah.
because of price and interest rates. So I'm seeing still, stagnation in the movement in some of these markets. So that's just, another data point to share
Yeah.
with you.
I like it. I'm taking lots of notes because we got lots of things to roll back to. The first one I want to go to, the first one I wrote down was the bifurcated consumer.
Yes.
I think that is something we all have to understand. And I think we had evidence of it in 2 earnings announcement. One was from McDonald's, and you could actually add Yum Brands that just released this morning, and Chipotle. Both of those, generically speaking, are kind of in the fast food or easy, dining,
Yes.
if you will. I think we're seeing the bifurcated consumer, right? So what do I mean by that? McDonald's and Yum Brands, which is KFC, Taco Bell, and Pizza Hut, all missed earnings, all had lower expectations for foot traffic.
Yes.
Chipotle went up, grew, had higher than expectations, blew out earnings. So even in a category, I would call Chipotle for the higher end consumer, right? A burrito bowl's $20 or whatever it is.
Yeah. I was just gonna
And
say, my son, I've sent my son a couple times, and instead of 10, they're 20.
yeah, so it's interesting. I think there's just more evidence that you're absolutely right. The economy, and this is part of the reason I want to be very clear that I think this is the worst case scenario for housing. I don't want to see the wealth gap explode even more than it is. It's already horrible today. My fear, and why I call it the worst case scenario, is over the next 18 to 36 months, the wealth gap goes up 50%. And how would that
Yeah.
happen? Asset owners see an artificial bump in appreciation because there's no supply. And
Right.
then we really could have that renter nation 2030, right? We really could take the thought of home ownership away of American dream. It's already hard today, but it
Sure.
could become seemingly impossible. And that's really where my heart's at. I was like, I don't want to see that.
Right. Absolutely. And I think you're right. I mean, the more and more I dig into the numbers, that are released on the health of the consumer, it drives me nuts when I hear the consumer is still strong, the recession is off, we've escaped any kind of hard landing. Michael, I will say that every single time there's been a recession in my, young adult life and beyond, and those that I've studied before then, the market always rallies right before. Everyone says it's different this time. Everyone says the consumer is strong. And then boom, all of a sudden, everyone's like, what happened? Everything was so strong a month ago. Well, no, it wasn't. The underlying
Right.
data is what you have to look at. And I'll give you a couple examples of this, wealth disparity. So one of the things that I look at, and I've been pulling up some data on it over the last couple of weeks, is auto loan delinquencies.
Mhm.
Okay. So during the pandemic, everybody went out after they got free money and went and bought new cars, and they financed those cars, and then they went and bought used cars. And so there was a lack of supply too of some new cars because they couldn't get parts from all over. So, you started to see used car prices skyrocket. And then there was a bidding war on new cars, just like there are in houses in some markets. And people started, taking on payments at high dollar amount purchases. Well, right now, this is in an article that I actually read, I think on Seeking Alpha, if I remember
I
correctly,
like Seeking Alpha.
that
Yep.
just came out this morning, actually, and backs up some other data that I was seeing in the auto loan area. So auto delinquencies, they are up to 7.7% overall.
Mhm.
And those who are in high income brackets, auto delinquencies are now 4.6%, which is really high for high income earners who are not subprime borrowers. So
Correct.
there is some struggling. And again, it kind of goes to this 88% are living check to check, no matter what your income is, because it's not as high as it was artificially with post-pandemic money, and the job market and big wage increases and people job hopping, et cetera. But it's still almost a double, not quite, but let's say 75%, rough math in my head, more on the low end are struggling to make their car payments than those on the high end. So
No question.
that's one thing. The other thing is when you dig into the unemployment numbers, even though unemployment nationally came out at 3.7%, and everybody says this is a great number, the consumer's doing great, most people are still employed. If you dig down into those numbers, Michael, there's two things I want to kind of point out. One is that when you look at the state level unemployment data, this is where data I know is manipulated. I don't know how and why, but it is, right? So the government doesn't want you to think unemployment's going high because they don't want you to think we're in a recession. That's one thing. But state by state, 88% of states have unemployment numbers that have gone up since the last report. 88%.
Yeah.
Of that number, I think 20% of states are already in recession. Okay, they've already said we're in recession. So if 88% of unemployment of states are saying unemployment numbers have gone up, then why is the national number down? Really? It doesn't make sense. But the other thing in that state job data that you can see is what types of jobs are people being more employed in versus, overall. And overall, most of the jobs have gone into the lower end. So there are more jobs in services and in food and in restaurants and in gas stations and, things that are $20 to $30 an hour employees. There are more jobs opening there and there are more people working those jobs, but a lot of them are working two jobs. And actually those that pay a little bit more, you're seeing more layoffs and you're seeing higher unemployment. And so those that are in the lower end are working additional jobs. And so there's a little more employment. Some are working two jobs, but most of the average to higher end or white collar jobs, unemployment is going up, meaning more and more people are losing jobs. They're not getting pay raises if you look at payroll statistics. And so again, I think that the high end is not struggling. True. But the other thing is when you look at job creation, how many jobs are open? This is where I always hear the strength of the consumer. Everybody's going to be fine. We all have lots of money. When rates come down, real estate's going to go nuts, right? Kind of this argument of the big city stuff. But when you look at job creation, and this is an interesting stat that I just saw, 2023, I will say this, they've looked at jobs and job creation pre-recession. And anytime that more than 10% of new jobs have been created by the government, their public sector jobs, we've had recession immediately follow. Okay. Last year, 2023, almost 25% of all jobs created were government jobs. 25%. So you're more than 2.5 times, 250% as many government jobs as what's generally preceded a recession. And if you add to that social service private sector jobs that benefit, any kind of human suffering, whether it be, more housing aid for renters assistance, things like that, or more homeless jobs or for migrants, it's over 80% of the jobs created in 2023 went to public service. And that tells you that the corporate sector that we're watching, the stock market, is only creating 12% of the jobs that are being created today. That is not a healthy economy. It means that corporate profits, corporations are not hiring. Not only are they laying off, but they haven't been hiring for a year. And that is going to manifest itself into, as the consumer starts to struggle, corporate profits being revised downward. And we're starting to see that. So the headline numbers that grab everybody, Michael, say corporate earnings were good, GDP was good, hiring and employment were good. But those numbers often get revised, and they're all revised downward in the last year. They just are, almost all. I shouldn't say all, that's never a good word, but the vast majority of the numbers that matter, that show the strength of the consumer, earnings, employment, et cetera, both corporate and individual, they're being revised downward, and then it's not hitting the media. So most people think, oh, Bidenomics is working and everything's fine and everybody should be happy with our economy, right? It's an election year. But people are feeling, no, I'm not getting better. What's wrong with me? And the reality is the economy is weakening significantly. So that view overall of all the data that I look at, Michael, makes me much less concerned that real estate is going to just skyrocket with high values. Everybody's going to be locked out. I think we hit a recession. I believe that we're in it now. I think it's coming. And I think that that's going to keep that supply really constrained for the majority of homeowners who are not in that higher income market. And maybe the high end goes higher, even though I saw the high end softening first. It may be what rebounds first. And I think we're in for more pain in the economy. Now, the good news as investors, because why did you say that's bad news? Because as an investor, you're competing with competing offers and high prices. There's always a rose to every thorn, right? The thorn is a recession. But the rose to that is when there is pain, that is when there's more opportunity for us to come in and help other people out, to have a solution to their problem that we didn't create, that is created by the economy, but I can help people out and also get really good deals on real estate to where I'm making an honest and fair profit because of what's going on in the economy. So I think it's getting worse, which is better for real estate investors, honestly. And it also
Yeah.
means the Fed will cut rates
Oh, yeah.
faster than they say they will,
Mhm.
in a lower rate than they say they will. So I'm looking forward to finally
Mhm.
the zero, I don't like the zero bound. I think we should never go back to where we
No.
were
Mm-mm.
before. If they do, it means the recession's really bad. So I think they're holding off a bit. And then once they can say, okay, we're in a recession, there's some things that are concerning, or a banking crisis, right? They cut rates. As soon as they cut rates, I'm number one, refinancing everything that I have commercial to a 10-year extension and locking in those low rates as long as I
Not
possibly
doing that
can.
again.
And I'm buying as much as I possibly can at those super low rates again. And I'm excited that there's negativity coming. So don't view this
Yeah.
as Anna's totally
Oh,
bearish. I
totally get
believe the economy is in a bad path. I think the rich are going to get richer if we know what to do. The poor
right.
are unfortunately going to be poorer, and we need to be able to be the people that can help them out, right? Not take
Mhm.
advantage of them. But there's huge opportunity coming, in my opinion, if we're really in a
Yes.
recession and heading there.
So let's play with that a little bit. I always like standing on my calls. So last year, Silicon Valley Bank blows up that weekend or that Monday. I called a recession Q3, Q4. It didn't
Yeah,
happen. I licked my wounds for a little while, and then I called a
me
recession,
too.
much like you, Q1,
Yep.
Q2. So like
Yep.
you, I think what I called was, I think Q1 will be a recession in Q2, meaning negative GDP. We won't know until late Q3, right? Because they're always backward looking.
Right.
That said, I had a very interesting conversation with a mortgage broker. I think it was last week. And something you and I talked about, I think it was 9 months ago, was the idea of a rolling recession, right?
Oh yeah.
Most of
Hmm.
the recessions we've experienced were kind of like it all falls apart, it all goes down, and then it all comes back. There was one rolling recession in the early 90s. It's often called, I think it was 91 was what they reference. And I am at least seeing early shoots that a rolling recession may happen, and it will be led
Yes.
by housing. So let me tell you what I see.
Yeah.
So first and foremost, what did we get right? You and I both said housing was going to go into a depression and transactions were going to crater. Congrats, we
Yeah.
got that right. But what I'm calling now is in 2024, Anna, I think transactions will go up 10%. I'm not talking price. Don't hear price. I'm talking
Right.
transactions.
But from a
But
low, low, low. So still
but
low transactions, but up. Yes,
but
I
up, but
agree.
year on
Yeah.
year, it's up 10%. That will
Yes.
be positive for GDP as opposed for 2 years being negative.
Right.
It's a la the 80s, right? We crashed in the late 70s and then we built for a decade coming out, but still
Hmm.
up from there. But what really shocked me is one of the people I talk to every Thursday, Convoy Home Loans. They said, Michael, we did something we haven't done in 2 years. And I'm like, what the heck could that be? We hired 3 people. Think about the mortgage business. The mortgage
Yeah.
business is roughly 50% the size it was 2.5 years ago. They are clearly at the bottoms of the dump depression. If
Right.
they're starting to hire, even incrementally, to me, it feels like, damn, this might be that rolling recession that's, that theory that we never get to see play out.
Right.
And then
Yeah.
we
And
have
I
home
think we've
builders
already
building.
been there.
Yeah,
Yeah.
I think,
Sorry.
yeah. And then, so if this plays out, if a rolling session transpires, housing, it will come out first because it got hit the hardest. Manufacturing is in it now. It'll come out next, right? It's just, you could see the dominoes. And what would that mean? It would mean we'd have below trend growth, but not negative, is how I see a rolling recession.
Right. And here's the difficulty with deeming a recession, right? The historic, general high level has been 2 quarters of negative GDP. But the reality is we had that and they
Yeah,
didn't
we did.
declare a recession, right?
Mhm.
Because unemployment was low. And so, for one of the reasons. And so, whether the NBER actually declares a recession, to your point, there are many areas of the economy that have been recessionary already for
Or
a year.
depression. Yeah.
Or exactly. So, housing, right? You look at manufacturing. Manufacturing was on the cusp of recession January 2019, and then it kind of reared back, right?
Mhm.
Then manufacturing is generally where most of GDP is produced in the past. And when you look at most leading economic indicators that we've been talking about, for a couple of years, the majority, 9 out of 10 leading economic indicators and the yield curve have been projecting a recession for over a year. It's
Oh,
just been
couple of
delayed, and
years, yeah.
everyone's saying, why is it delayed? But it's very heavily skewed to manufacturing because that's
Mhm.
where so much of our production has been done in the past. And what happened was manufacturing dipped into a recession already into 2022, part of 2023. And what happened was the GDP just shifted into services. So while services is booming and that kept GDP high and government spending kept GDP high, if you again break down that GDP number, manufacturing was down, industrial was booming. Now it's in a recession. And so
Mhm.
you have these different sectors of the economy that are definitely already struggling and struggling substantially. Tech was up, but what's happening in tech now? Now there's still some good, but AI hasn't
Mm.
quite kicked off as people thought, and tech companies are starting to lay people off, right? And so
Yeah,
I do think you
let's talk
get
about
this.
tech. Let's talk about tech
Yeah,
because again, I could be self-biased. I mean, I understand, but I'm trying to read all of these things.
yeah,
You're absolutely right. So I live in Silicon Valley. One of my homes is there. I know people in tech. Uh, Tech had a really hard last summer, right? When Amazon was 10,000 and Facebook was 12,000 or whatever the big numbers were. Now they're tinkering at the edges, 100 here, 250 there. For a company that's got 30,000 or 50,000 employees, that's a fart in the wind. That's nothing, but it still makes headlines.
right.
One of the important things in the Facebook announcement or Meta that most people missed is they're going to start hiring again. They've been basically on a hiring freeze for 9 months. They're starting to hire.
Okay, I didn't see that.
So it's like these green shoots. They're very small, and you've got to seek them out. But I'm
Right.
like, oh my God, could we actually see a true rolling recession, which is something I've read about and studied in economics, but like it's like a unicorn. You never think you would see one, but
Sure.
it's
Yeah,
just weird.
I think we will. And again, not just because we're in a recession doesn't always mean that everything's in a recession either. So lots of recessions have in some ways, some rolling of the recession in and of itself, because every recession varies in everyone thinks about how long will it be and how bad will it be, but how diffuse it is really how many industries are impacted by it and in that recession. So recessions are measured in length of time,
Yeah.
how deep, how high is the unemployment, how high are the layoffs, how low is the GDP, but then it's diffusion across multiple sectors of the economy. And if you look at 2001 with the dot-com bubble, not every area of the economy was in a recession, right? And so I think that generally speaking, we've been in a rolling recession. Maybe not technically, but there's been pockets of strength. But again, when you come back to the leading economic indicators, and again, it's more manufacturing driven than it is necessarily farming and some other things, but 9 of 10 leading indicators has been in recessionary territory, meaning in recession or just barely above it and floating along that recession line of really low for a year, Michael. And
Oh
so
yeah.
when I look at the leading economic indicators is basically a conglomeration of about 10 indicators of the health of the economy. And when all of that is negative and you start to see the yield curve uninvert, it's a real strong
Yeah.
sign that we are heading for a national recession. So I think a recession's finally going to be declared. I think it's just taken this long because again, GDP was technically positive and unemployment, even though it's ticking up, if you look at the state responses,
Mhm.
it's about 4.1% versus the headline that was 3.7. So it's still higher than, what Powell is saying. But
Mhm.
I truly think we're in a recession. It's been rolling, and I think it's finally going to be declared because there really is no number that's really super positive other than the stock market has held on and been booming, and those with money are still spending, but most
Okay.
people are not. So that's kind of where I think I still stand by, In the longer term, I think we're in for stagflation, but we're
Mhm.
going to have these opportunities in the short term cycle. We're finally about to bottom out, I think, in a recession. That's the short term trends, the cyclical trends, and you've got your secular trends. So I think over the long term, I wouldn't be surprised if we have longer term rolling recessions
Oh,
where
yeah.
some come out of the recession, some stay in it, and we have low growth and we have higher inflation coming back at some
Mhm.
point.
Yep.
And we have a low growth decade, kind of a lost decade. So we've got to find those pockets of
Yeah.
change in the cyclical short-term changes in this longer secular trend, I think, of lower growth, higher inflation, higher taxes. That's coming for sure too, probably a topic for another show. But
Mhm.
there's pockets of opportunity. And I look at this as, okay, 2022, was pretty good the first half. Late 2022 was tough. 2023 was tough as real estate investors to find, especially if you're in commercial, right? We're already in a deep commercial depression, I would say, unlike residential being transactions. Commercial, it's also asset prices. But I think as rates come back down in a recession, that's good for asset prices when rates are low and they're rate driven or impacted by interest rates. So I'm optimistic about the next year and a half, even though I think we're going to be in a recession. I'm looking at it as a huge opportunity, to really make some money where it's been tough over the last year and a half to find great
Yeah.
smoking deals. I think more are coming.
No, I agree with all that. The other thing I wrote down that you talked about that we're just going to work in here is Airbnb, right? You talked about a couple of your 5 listings you have out there. I want to give a shout out to people that I think called this first, at least in my world. Melody Wright on Twitter. She's been on the channel a couple of times. And then there's a Twitter handle called Texas Runner, I think is what she goes by. Both of them have been talking about Airbnb. But what I wanted to go to you, Anna, on is I think there's a big question. I'll say it this way. There was a lot of buyers who, frankly, I'm going to say lied on the mortgage application. They said it was a second home.
Yeah.
They said they were going to live there, whatever the number is, the 30 days a year or whatever it is. And it was always going to be an Airbnb. They just lied to get the best rates. They lied to get the lowest down. All of that. And a lot of these folks took out DSCR loans, right? Not conventional. Um, I'm
Can I
just
push back
wondering.
on something real quick
Yeah,
that you just
please,
said, just to
please.
clarify? So, one, DSCR loans in and of themselves are made for those who are not going to occupy. So, if you tell
True.
them it's a
That's
second
true.
home, I'm going to occupy, you can't get a DSCR loan.
You're right. You're
And
right.
the thing about second homes, in order to qualify for a home loan that's a second loan, you have to qualify for the mortgage, even if you never brought any income in, because I've done several of them.
Ah,
So
interesting.
it actually is harder to qualify for a second home loan.
Okay.
And you can say, this is my second home and I intend to rent it out. But even if you intend to rent it out, they give you $0 to qualify for that loan. So they give
Interesting.
you the loan as if you're never going to get rental income.
Okay.
So it's harder to lie on those because they're much harder to qualify for. Where I
Okay.
think that you do have some of that is people that say, and even then, people that aren't buying it as a second home, that they're going to rent it out, maybe they boost what they think the income is, but that's hard to get by with the loan apps because they do appraisals, they do rent valuations, they do. So I think mortgage fraud in the short-term rentals is probably much, much lower than
Okay.
what you just said, just because
Good.
I've had to qualify for all kinds. And none of them, even second homes, prevent you from renting them out. It just makes it
Okay.
harder to qualify for, but you can get in with 10% down instead of 20 and you get
Okay.
a much better rate.
This is why I come to you because I don't have any of these. I just read what I'll call
Yeah.
doom comments.
Yeah.
So is it so what I guess I hear you saying is, yeah, there might be some, I'll call it mortgage fraud. I'm not sure what to call it other than that, but not as much as maybe some folks fear because again, the qualification was different. DSCRs, you
Yeah.
can't say you're owning.
I can tell you this, I'm mostly commercial, but I have all the other stuff that I've bought, whether it's big or small. I've used
Mhm.
smaller regional banks because
Yep.
they know me. It's easier to qualify for loans. Going through government approval process for 30-year fixed financing
Yeah.
is brutal. And the more you have and the more you're invested in, the harder it is. And so
Amen to that. Man.
every
Brutal.
time, the last one I did was my 5th short-term rental, and I went through Fannie Mae 30-year fixed financing, second home if I qualified, and by the 5th one, I didn't have enough income if I couldn't use any of it to get the 10% down. So I went investment property loan, 15% down, a little bit higher interest rate, but still pretty good. I swear I'll never do it again because it's such
Oh
a
yeah.
headache, and it's always to the last minute the way they calculate things, and so it's hard to qualify for those. And
Okay.
DSCR, if there's any fraud that went through, and I'm not saying that there isn't, but
Right.
more than anything, I think if you have appraisals that give it a higher value or a higher rental value
Mm.
than what has been proven historic, or it relied on 2021 data, 2022 data, when you
Yeah.
had really high income.
You
To
got some
me,
of that.
that's where the bigger
Yeah.
issue is. And it
Okay.
not necessarily that there was fraud, but there was this exuberance on the
Yeah.
part of both the investor
Bubble.
and the
Yeah.
lender,
Yeah.
because the lender wants to do loans. They're paid to do loans, right? They want to give you loans. So I think they're going, hey, if you can show me some stats of comparable properties that got this much last year, we'll
Yeah.
give you credit for that much income. And what's
Okay.
happening is that last year, rental income softened in most markets. Now you'll look at stats again nationally, Airbnb, type of Airbnb, VRBO, Mash Pfizer, they put out stats, they say income was up, but it was only up in certain areas and certain markets. And so the issue for me was short-term rentals. And I knew this could happen. And I think I talked about this on the show when I bought a few of them, right? I said, I'm taking advantage of record low interest rates that I can lock in for 30 years. And for me, they're lifestyle investments that I can rent them out and make it cost me nothing to enjoy homes, pass them to my children. I have some appreciation. I have huge tax benefits. And I think some of them are going to go up in value. And I bought kind of strategically. But I even said, even if they don't go up in value, because we start to have some kind of real estate correction or there's oversaturation, I bought them knowing that I could afford to hold them. Even if we had a recession, that was my biggest fear. Even in 2021 and 22, when I bought them, I said, I think we're heading to a recession. I think my income's going to be lower. So what I did when I estimated my numbers is I took a lower new number for income than what they had made the year before. So I wasn't going to be super disappointed because I was conservative. But what most people did, Michael, is this is what happened in short-term rentals. They said, I got a little extra money. I'm going to put it on a down payment. And I've been told by all the gurus that I'm going to make $50,000 a year on this one property. And because short-term rental travel was so high in 2021, around water and mountains, that's just always where values go up and people rent. They assumed that that's always what they were going to make, and they weren't able to afford to hold it without that much income coming in. So they bid up the price to get a high enough, the biggest property they could get with the most rental income. And now that travel has softened, especially in the $1 million home range, where they just thought they're all going to be there. Well, then suddenly, like in Pigeon Forge, for example, hundreds and hundreds and hundreds of $1 million homes were built. Well, there's not that many families that want to rent $1 million home that are still renting them at that pace. So they assumed great income. They didn't assume any softening or any recession bringing income down. And suddenly they can't make the mortgage payment because not enough people are traveling at those high rates. So I think that's the real issue, is that people bought on hopium. They thought 1 year was enough. That locked themselves into the mortgage payment, but that rental income is soft and now they can afford it. And so what's happening is a lot of people are listing their properties. And so the supply is up in those markets.
Yeah.
Yes, there's offers, but they're trying to lowball the most motivated seller, because those that are selling right now, there's a few of us like me that are like, if I can still get top dollar, because I think there's some softening, I might go ahead and sell one or two. I want some liquidity to take advantage of some other things, but if I don't sell it, I don't have to. So I'm just like putting it out there and seeing. But most people that are listed right now, they're highly motivated because they overbought. They overestimated income. They're living check to check and they just can't afford to float those payments, especially when it's not summer season. So pain is coming there for sure. I was trying to get ahead of it with the sell of one of mine. The other thing that's happened, Michael, and this has happened this will happen in residential, but it's first, I think, in some of the short-term rental markets. So why am I selling one of mine in Florida? I have two and I love them. They're both oceanfront, but my taxes almost doubled in 2 years. I estimate taxes going up to the new, the new purchase price time the millage rate. I always include that
Yep.
when I'm estimating numbers, but it went way up more than that. But my insurance has more than doubled on both Florida properties in a year and a half. And there's no end in sight as to that happening. So in markets like Louisiana, coastal markets, California, Florida, the taxes and insurance have eaten in so much to the income as well as a decline in rental rates. It just means that you're cash flowing a lot less. And that is something that nobody really could have anticipated, that insurance would gone up as much as it has. I mean, I had a property go from 12,000 to 23,000 in a year just for
Yeah.
insurance, So that's going to mean a lot of people put their house on the market, a lot of increase of supply. But on the negative end, those who are buying them today have higher interest rates. Even if the price comes down, they can't cover the new taxes and insurance and still be as profitable. What does that do? It brings down prices. So if you're
Yep.
selling, that's bad. But if you want to buy something you're going to hold long term, those are markets you want to go into and pick them up at a depressed price because they're not working today, and you hold them and you hope that all these things work themselves out. But short-term rentals are just a different breed, and they've got their own challenges. But if you're in a coastal market, I think that prices still could fall, unlike these big cities you were talking about at the beginning of the show, Chicago,
Okay.
Seattle, where prices are starting to go up.
Okay. Well, let's get into one more topic that we'll talk about, and that's banking crisis 2.0. I'm sure you've seen the headlines with, I think it's New York
Oh,
Bank
yes.
Corp identifying some
Yes.
commercial loans blowing up. It feels to me that we have yet to see the blow up because of commercial real estate, and it's coming.
Yes.
And maybe it's starting to happen. Maybe we're in the early, maybe New York Bank Corp's first. It has to happen,
Yeah.
right? There's got to be banking crisis
Absolutely.
2.0.
And after we had the first couple banks, Signature Bank, SVP, start to go down, and the Fed came in with the bank rescue program, right? I said,
Bailout.
Bailout, exactly, exactly. I said this is for bonds now, but commercial real estate has the same problem, right? And a lot of people
Exactly.
were just
That's
worried
my
about
thing.
bonds
Yeah, me too.
because the issue is, and again, yes, they had a lot of tech investors. They snapped their fingers and everybody pulled their money at one time. So yes,
Yeah.
there's part of that. But the
Sure.
reality is most banks are required to hold certain assets that that have been considered low risk, the lowest risk assets for a long time, especially post 2008. Bonds, commercial real estate, high
Yeah.
quality commercial real estate, right?
Agreed.
So
Yep.
banks hold those safe assets on the books, and they're safe unless the Fed historically raises rates 5%. And suddenly the value of bonds and commercial real estate, just by nature of the rates, crashes. People don't understand, why is there so much risk at commercial real estate? Okay, office has 30% vacancy, but commercial real estate, for those that don't know, is valued based on the income divided by a cap rate. And a cap rate is essentially a going rate of return that an investor expects to make on the income based on their purchase price if they paid cash. So you're comparing dollars, apples to apples, treasuries to real estate, right? Well, if a treasury was paying 1, which it was a few years ago and some change, I would want a 3.5% return if I paid cash for a brand new apartment building. Okay. That's a 3.5 cap. But when a treasury goes to 4, I want a 6.5 cap because I'm taking risk above what I could park it in the treasury. So if I take the same income on the same great property, but I just divide it and say, now my investors want a 6.5% return instead of a 3.5% return, Michael, that drops the value they're willing to pay for that asset by 50%. So
Yeah.
we've already seen
It's
30 to
50.
40%
Exactly.
decreases in value. And a lot of, unfortunately, operators having to hand over the keys. It's not because they did something shady. Yes, it's easy to pile on them. Some took risks, right? We're all in the business of taking risk for higher reward than what we can get in a treasury. If we're all honest with ourselves, every one of us is in the business of taking risk, right? Some took more risk than they should have. But the bottom line is, commercial real estate loans are not fixed for 30 years like residential.
Yep.
So we don't get that benefit. So most investors took out floating rate debt because the Fed said, we're not going to raise rates.
Yeah, they did.
Inflation's fine. We're not going to raise rates. And brokers told us, Anna, the Fed said they're not going to raise rates. Get a variable loan because you don't want $1 million plus prepayment penalty if you lock in for 5 and sell in 2 or 3. Okay. and we'll just give you rate insurance that'll cap the amount that you pay. And people bought that, but the rates went way up from there and they have to be refinanced. So to the point about the banks, just like you had bonds maturing that once were worth this when they paid 2% coupon, now that someone could buy one at a 4% coupon, the bonds drop 50% in value. Those are a large piece of the assets on the bank's books. So if their asset value falls below their liabilities, they're insolvent and they fail. Well, same thing with commercial real estate. They've got these loans on the books, especially regional banks, not your Chase, Wells Fargo, JP, whatnot,
Regional.
but your regional banks. They hold about, depending on who you look, 60 to 80% of commercial real estate. Okay. Suddenly the value of their assets, let's just say they've all been cut 40 to 50%. If you've got a large amount on your books of commercial real estate and you have to mark them to market. So this was the whole thing. There's hold to maturity securities, which includes, commercial real estate loans, bonds, things like that. And then there's available for sale. They hold them to maturity so they don't have to write down the value. But the minute they have to make them available to sell, which happens when they had to come up for refi, they have to mark them down, and that brings their asset values down. So a lot of these loans were done, Michael, in 2021 and 2022. Most have a 2 to 3 year with 1 year extension. So let's say 3 to 4 years from 2021. 2024 is just really the beginning. Now, some had a lot of them were 2-year loans with a 1-year extension. So 2021 took you to 2023. That's when we started seeing the problems. They wouldn't extend them a year. Now we're in 2024. So this year is really the first year where you're going to start seeing more fallout than what we had before and into 2025. And so I believe that a lot of regional banks, and here's the problem. They can't just, I heard this argument, they can't just say, we will extend and pretend. Your property value is less today and rates are higher, but we're just going to keep letting you pay a lower interest rate. They can't, because banking regulations, rules, things that they buy to offset the interest rate that they offer, tell the banks when they come up for refi, you have to recheck their loan to value. You have to recheck their debt coverage service ratio. Auditors look at that every year. When I send my financials in every year, they look at that, right? Now, if it's not up for renewal and I'm making my payment, they're not going to try to go, well, you got to pay more because we think it's worth less. But when it comes up to renew the rate, they re-underwrite you, whether you have to refi into a new loan or just update your rate. And because values have fallen 50%, and these loans were done at 75 to 80% LTV, you owe 20 to 25% more than what it's worth.
Mailing in the keys.
The banks cannot legislatively, based on bank regs, refi a loan without making you pay in money to get that loan value and payment where it needs to be. So banks are in a lot of trouble as soon as these loans come up for renewal, unless the Fed comes in with another rescue program. And that's why the economy sometimes is really hard to peg, because I can say we should be repeating a savings and loan crisis of 1980s after the 1970s did the same thing.
I agree.
That's what is coming. But the question is, our Fed and our Treasury have shown since 2008, they are willing to do whatever it takes to stop contagion. And so I think they start backdoor negotiating rescues of these failing banks.
I agree.
They come up with additional bank rescue programs. It's supposed to expire in March. I don't think it's going to.
Oh, it'll be renamed something else. Yep.
It'll be something else. So the Fed will not let the banking system fail, but they will let the syndicators and the operators lose and the funds lose their property. Then they're going to work with the banks to say, how do we keep you open when this is a temporary blip in value? Or then they slash rates. Then your assets are revalued and asset prices go back up and the bank is okay. Right. So that's kind of what I expect. But, what do I know?
We will dig into this banking crisis 2.0 next week, because I think there's a lot more there. Anna, real quick, where can people find you?
Great. You can find me here every week on your channel. If you're interested in real estate coaching or deal review consulting, you can find me at AnnaKellyInvesting.com.
Thank you so much.